Introduction. Risk comes from not knowing what you are doing by Warren Buffett. If you visit a branch of a typical private sector bank in India on a Saturday afternoon, you will notice most relationship managers, RMS, selling packaged financial products. That is, synthetic instruments that offer exposure to more than one financial asset in a packaged form, which modifies that exposure compared to a direct holding in any one financial asset. However, if you listen closely to what the RM is saying, you will find that little of it is genuine advice, most of it is promotional literature disguised as financial advice. One of the greatest examples of mis-selling by financial intermediaries in India has been unit-linked insurance plans, ULIPs. ULIPs are push products and thus require high brokerage commissions to be sold, i.e. customers do not of their own volition buy these products unless an RM cajoles them into doing so. The fact that the tenor runs into decades allows the manufacturer to implicitly charge the customer a hefty upfront brokerage commission. These used to be as high as 40 to 60% of the first year premium, and yet promise good absolute returns. Halen, Sain and Thomas estimated that Indian investors had lost more than Rs 1.5 lakh crore, approximately $23 billion yes, billion, on these products because of lapsing. This was because investors were not informed about the compulsory investment required in subsequent years. This allowed insurance companies to confiscate investors' funds when they did not make payments in subsequent years. Unfortunately, such mis-selling is not just a thing of the past. It continues to characterize the financial services landscape in India. A diligent investor seeks to avoid getting trapped in such mis-selling by reading up on his own. However, a visit to any good bookshop shows that finding a good book on investing in the Indian context is not an easy task. Though there is no shortage of great books by global gurus that can inform the Indian investor about how to build his investment portfolio, the relevance of global literature to India becomes limited because of a combination of three factors. Firstly, there is an overwhelming dominance of physical investments like gold and real estate in most Indian households' portfolios. A recent RBI committee opined that 88% of an Indian investor's wealth is in gold and real estate, a dominance not seen in any other large economy of the world. Moreover, issues around illiquidity, emotional connect and unfavorable capital gains taxation make it harder for investors to move away from such existing physical investments. Secondly, the culture of stock market investments in India is only 2 decades old. With the regulatory supervision of the Indian capital markets still evolving, and given the irregular quality of financial reporting by Indian companies, it is difficult for an average investor to make an informed decision. Thirdly, unlike the stock markets in some developed countries, the Indian stock market has very few great companies that sustain leadership over long periods of time. This point is demonstrated clearly through the following analysis from Ambit Capital's research. The average probability of a sector leader remaining a sector leader 5 years later is only 15%, implying that 85% of BSE 500 companies slide towards mediocrity. In fact, the average probability of a great company becoming a sector laggard 5 years later is 25%. Even the Nifty churns by around 50% or so every decade, as compared to around 25% for developed markets and around 30 to 40% in other major emerging markets. Furthermore, the tendency for large, successful companies to slide down the market cap spectrum is not confined to the Nifty. A guide to portfolio construction and investment in India needs to take heed of these peculiarities. This book aims to be such a guide. This book can be read in 2 ways. An affluent professional or entrepreneur should read it chapter by chapter, and his/her portfolio should be spread across both equities and bonds. Of particular relevance for such a reader are Chapter 1, Mr. Tulwar's Uncertain Future, Chapter 7, Pulling It All Together, and Chapter 8, Designing Your Own Financial Plan. Alternatively, someone who seeks more specific guidance on how to build a high-quality equity portfolio should carefully read Chapter 2, Coffee Can Investing, Chapter 5, Small is Beautiful, Chapter 6, How Patience and Quality Intertwine, and Appendix 1 to see how the Coffee Can portfolio works. Chapter 1. Mr. Tulwar's Uncertain Future. The best time to plant a tree was 20 years ago. The second best time is now. Ancient Chinese saying. An evening of celebration and reflection. Even by the standards of North India, it was an unusually hot June evening with the mercury hovering at 42 degrees Celsius. As is the norm during the evening rush hour, all roads leading away from Noida were gridlocked with bumper-to-bumper traffic. However, in flat number 901 of a viral housing society, located just 5 minutes off the Delhi-Agra Expressway, the Tulwar household was celebrating a special evening. Yogesh Tulwar beamed happily at the small gathering that had come together to celebrate his son's success in the Class 12 board exams. Ronit had scored 93% and stood third Indiana his class. It was time to celebrate as all the relatives commented on what a great future awaited Ronit. As immortalized in the classic 1967 movie The Graduate, relatives and family friends congratulated the young man and told him what they thought he should do with his life. Dustin Hoffman plays the graduate in this super hit movie that made him a star, earned him his first Oscar nomination and captured the spirit of that remarkable decade. Mr. Tulwar felt a little uneasy about the happy predictions for his son. In the midst of the hubbub he could sense that something was not right, but he could not pinpoint the reasons for his disquiet. Once the guests were gone, he sat in the balcony with his favorite single malt and let his mind drift over his own career. As he looked out towards the sea of skyscrapers, most of them half-completed buildings abandoned by real estate developers, that is Greater Noida, Mr. Tulwar's mind retraced the steps of his distinguished corporate career. He had done well academically. After completing his undergraduate degree in engineering from the highly rated Regional Engineering College in Telangana's Warangal, formerly Andhra Pradesh, he had gone on to finish his studies at a reputed business school Management Development Institute, MDI, in Gurgaon. His MBA from MDI, coupled with a solid academic record, had helped Yogesh Tulwar get a good job with a leading multinational company with an attractive salary of Rs 2 lakh per annum. He had stars in his eyes and the world was his to conquer. That was 1990, but it seemed like yesterday. The years had flown by since then, but even in the tumult of post-1991 India, Mr. Tulwar had broadly done the right things. To begin with, he had married a smart girl. Kusum was a teacher at a private school in Noida. Kusum and Yogesh's children, Akanksha and Ronit, were bright, hard-working and well-behaved. Akanksha was pursuing a postgraduate degree in biotechnology in Bangalore and Ronit was awaiting his engineering entrance exam results. Mr. Tulwar had a settled life, and yet he felt deeply unsettled. Over the years, especially in the last 4 to 5 years, he had started feeling like an underachiever despite working hard over his 25-year corporate career. When he had started working, he told himself that he would retire at the age of 40. That 40 had become 45 and now here he was at 50 years of age. And yet, despite all the hard work, Mr. Tulwar felt almost as financially unsecure as he was when he graduated from business school. He had started working in 1990, just as India was about to open its doors to liberalization. It was a good time to work with a private firm. His career had progressed better compared to some of his friends who had joined public sector companies. The yearly increments were great too. For the first few years, the young Yogesh never needed to save. He spent his income on a bike, on travel, and on social outings. He was a generous man who stood by his friends. But most of the loans he gave to them never came back. He got married in 1995 at the age of 28 and that didn't change his lifestyle much. It was only when Akanksha was born in 1996 that Kusum and he realized the need to build a financial buffer. Mr. Tulwar booked his first fixed deposit, FD, within a few days of Akanksha's birth. Over the years, FDs remained his preferred investment. The Tulwars also kept buying gold, whenever possible, as jewelry for Kusum. Gold not only conformed to traditional wisdom, about it being a reliable store of value, but would also come handy when it was time for Akanksha to get married. Some of his colleagues would invest in stocks, but between 1991 and 2004 the Indian stock market was characterized by regular share price rigging scams, and Mr. Talwar saw investors in stocks as punters. Like most well-educated Indians, he saw the stock market as an unknown area of darkness. In fact, he had seen most of his friends losing significant amounts of money every now and then in the stock market. In 1999, Mr. Talwar bought his first flat in Noida. This was more on the insistence of his parents, who had scored a hat trick by pushing him into the three big decisions of his life: marriage, children, and now the house. It was a matter of pride for them that their son owned a house at 32 years of age, because they were only able to afford it in their 50s. The house was purchased using a home loan. In those days, interest rates were as high as 13 to 14%. The monthly installments forced the Talwars to live a hand-to-mouth existence for years. They had to break their FDs to buy the house. As a result, through their 30s all their savings were invested in real estate. Thankfully, interest rates came down over the years and Mr. Talwar's salary increased. As the burden of the monthly installments eased, the family breathed easier. It allowed the Talwars to start saving again, and they turned to their old friend fixed deposits. But this time, Mr. Talwar was a little more aggressive. In the post-2000 India, he bought stocks. This was based on the collective wisdom of a small group of stock investors in his office. In those days, stock investing meant trading. There was no concept of holding a stock for the long term. One bought a stock, watched it like a hawk, and sold it once the price went up. Being able to exit a stock at a high point was considered an art and gave one bragging rights in the office. Mr. Talwar loved the highs of stock investing. However, for reasons he could not understand, his portfolio did not grow much. The high brokerage, which is the commission charged by the broker, and the frequent churn in Mr. Talwar's portfolio, driven as it was by office gossip, meant that it was the broker who made all the money. The brokerage used to be in excess of 1% of the transaction value Indiana those days. Then came the bull run. While his stock portfolio was meager, the value of his house appreciated by leaps and bounds as both equity and real estate prices increased multifold in that period. But this did not mean much in terms of cash flow, as he was staying in the house and had no intention of selling it. But it felt good to be a crorepati. Like some of his wealthier friends, he also started lending funds to real estate builders through a private network hidden from the taxman. At 2.5% per month interest, it beat any other investment Mr. Talwar had made in his life, and he kicked himself for not doing this earlier. The money always came back and there were always more builders to lend to. Mr. Talwar loved real estate as an asset class. All around the country people were buying property and getting richer. He didn't want to miss out. The willingness of the banks to grant home loans of up to 90% of the property value meant that an appreciation of 50% in the value of the property, which, as per Mr. Talwar, was a given, was actually a 500% return on investment. So, other than the flat he lived in a viral housing society, he booked another flat in a luxury high-rise complex called Empire Apartments that was under construction in Noida. The National Capital Region was witnessing a boom. One could actually see the growth as the high-rises in Noida and Gurgaon reached for the sky. Mr. Talwar was now hopeful. Finally, he thought, India had stopped whining and started shining. One day the gravy train stopped. First came the stock market crash of 2008 between January and November of 2008, when the Nifty fell 55%. The crash almost entirely wiped out Mr. Talwar's stock portfolio, since most of the stocks were speculative investments made on the basis of tips from colleagues and his stockbroker. However, he remained optimistic as most of his wealth was invested in real estate. In fact, after seeing the stock market sink, Mr. Talwar was completely convinced about the infallibility of the Indian real estate. After all, as his friend Mr. Kalra put it, a house was a real asset bound to go up in value in a country with a housing shortage, whereas stocks were only pieces of paper with no certain value. Mr. Talwar swore never to invest in stocks and doubled down on real estate in the form of paying the next installment for the flat he had booked in Empire Apartments. However, soon the real estate engine too started sputtering. The first signs were the plateauing of house prices in 2013. Indian investors had seen property prices going up almost on a monthly basis, and a continuous price appreciation was taken for granted. While the stagnation in prices upset Mr. Tulwar, he wasn't alarmed as yet, as the press said that this was just a temporary demand slowdown. The real estate pundits, i.e. property developers and property brokers, who were featured on the financial news channels, said that it was a matter of time before house prices picked up again. Unfortunately, the slowdown in demand continued from 2013 to 2017, and prices continued correcting in some form or the other. The real estate developers started defaulting on loans from 2015 as they ran out of customers who would pay for their overpriced flats. Mr. Tulwar was now dealt with a double blow. The money that he had lent to the builders was stuck, and so was the flat that he had booked in Empire Apartments. The flat, which was supposed to be delivered in 3 years, was now in its 6th year of construction and still a long way from completion. The builder had drawn down more than 95% of the price of the flat and still did not have money to finish the project. Unfortunately, there were scores of such cases in Noida. Apart from a long court battle with the builder, which he was pursuing with his fellow house buyers, there was nothing else that Mr. Tulwar could do. Thus, his dalliance with the stock market and real estate had ended in severe financial reverses even as the clock ticked down on his career. He poured himself another peg and switched on the TV. A one-day international match that India had won against Pakistan 5 years ago was being telecast. But Mr. Tulwar's mind was somewhere else. He was 50 years old now and had another 10 years of working life ahead of him. Apart from his investment in property, he had some savings in FDS and in gold. He had also taken a few insurance policies whose worth he never got around to assessing fully. Assuming that after his retirement he and Kusum lived for another 30 years, they would need at least Rs 30 lakh per annum post-tax to enjoy a comfortable life. An amount of Rs 30 lakh per annum over 30 years was a lot of money. I need at least Rs 9 crore. Where will I get that sort of money from, thought Mr. Tulwar. Like the Indian innings on TV, his career was also entering its final 10 overs, and he had to make it count. How could he make the most of it? The Indian team had held Mahendra Singh Dhoni back for the big hits in the slog overs. Who would bet for Mr. Tulwar in the slog overs of his career? The question kept troubling him. Just as he was about to pour himself another peg, Kusum entered the room and said, "Shouldn't we call it a day? Sitting alone in the dark with a glass of scotch is not going to help. Let's get some sleep and have a chat over a hot cup of coffee tomorrow morning." Mr. Tulwar sighed. His wife had always been a more level-headed person than him. Noida is not just home to thousands of successful executives like Mr. Tulwar but also houses close to 2,500 manufacturing businesses. Amongst the 700 ODD textile firms in Noida, Mukesh Sanghvi's firm was one of the oldest. The Sanghvi family had run textile plants for generations. While their pot of wealth had grown over the generations, their business was now facing acute competition from Bangladesh, where wages are a third of what they are in India. On top of that, the Sanghvi family was dealing with unfavorable labor and tax regulations. The firm had also taken on a lot of debt lately, and the Sanghvi's 2 brothers and a sister had decided to put the business into liquidation. Each sibling wanted to pursue a new line of business/profession, but Mukesh Sanghvi was clear that at 55 years of age, he wanted to take it easy and live off his accumulated wealth. It was by no means meager. According to a rough estimate, he had Rs 25 crore spread across assets like residential and commercial properties, gold, FDS, stocks, and a significant amount of cash he would receive from the liquidation. However, he was aware that his existing lifestyle meant that he would require a very large annual surplus to support it. He had 2 sons and a daughter. The oldest, Sujay, was 25 years old and worked as a manager in Mr. Sanghvi's friend's pharmaceutical firm. The other 2 children, Nirmish, aged 23, and Komal, aged 20, were studying in the US and the UK respectively. The family liked the good things in life. They went for 3 overseas holidays every year and changed their luxury, German, cars every other year. Given that Mr. Sanghvi had let go of the business, he was nervous and unsure about whether his corpus would be enough to meet his family's requirements. After all, the family's annual financial outgo was Rs 1.5 to 2 crore, and if he had to sustain that for another 30 years, he needed a corpus of at least Rs 50 crore. So far, the sole source of income for Mr. Sanghvi was the dividends he received from the company and the large salary he drew as the firm's director. His wife had bought a lot of jewelry over the years and they had a few commercial properties. He was very active in the local hundi circuit where people lent each other unsecured loans for as much as 25% per annum on an annualized basis, without declaring anything to the taxman. Over the years, Mr. Sanghvi had had multiple trysts with the stock market. He was a punter by nature and liked making aggressive bets. In fact, Mr. Sanghvi dealt in the futures and options market and took leveraged positions in stocks. At the peak of the bull cycle in January 2008, he was worth Rs 150 crore, but by November 2008 his net worth had fallen so much that he was teetering on the brink of bankruptcy, all thanks to the margin calls that his brokers had made on him. He had sworn to never make that mistake again and hence missed out on the 145% rally Indiana the Nifty between March 2009 and November 2010. Seeing his friends make money over that period had made Mr. Sanghvi envious. So, when Narendra Modi took over as the Prime Minister of India in May 2014, Mr. Sanghvi decided it was high time that he re-entered the markets. That was then. Now, with the business liquidated and the dividends gone, Mr. Sanghvi was scratching his head to figure out how to finance the rest of his retirement, his family's lifestyle and his children's education on a paltry corpus of Rs 25 crore. Enter the advisor Nikhil. Over steaming cups of masala chai, poha, and fruits the next morning, Kusum understood what was worrying her husband. She told him that their neighbors, the Krishnans, had found it useful to see a financial advisor from a wealth management firm. She called the Krishnans over for breakfast and they pointed the Tulwars towards Nikhil Banerjee, a senior relationship manager with a reputed wealth management firm. When Nikhil came to meet Mr. Tulwar, he carried a laptop with a financial planning software package. The meeting lasted more than 3 hours and the results were a revelation for Mr. Tulwar. Nikhil told Mr. Tulwar that the key was to quantify everything since reality is different from perception and hard numbers help differentiate one from the other. The first thing they did together was to quantify the Tulwar's net worth. Next, they calculated the return his portfolio had generated for him over the past 27 years. They segmented the numbers methodically so that Mr. Tulwar could see the returns that each asset class generated for him. The results stunned Mr. Tulwar. On a weighted average basis, he had earned a return of only 4% per annum over these 27 years. Mr. Tulwar held his head in his hands. The past had to be left behind, Nikhil comforted Mr. Tulwar. But at the same time, Nikhil said that if Mr. Tulwar did not learn from his mistakes, he was staring at a very uncertain future. It was important for Mr. Tulwar to assess the kind of returns that he would need from his portfolio. The required returns were actually a function of the financial goals he had in the coming years. Mr. Tulwar, guided by Nikhil, wrote down his primary financial goals. When Nikhil uploaded these goals on the financial planning software, he had to account for an important adjustment: inflation. The current cost was compounding at the rate of inflation and becoming uncomfortably high at the time of actual occurrence. For example, Akanksha's wedding, which would cost Rs 70 lakh now, would cost Rs 1.2 crore in 2024, assuming an inflation rate of 8%. The software showed the devastating effect inflation would have on Mr. Tulwar's cash flow. It showed that at the current rate of savings, income minus expenses, and returns on his investments, his standard of living would come drastically down once he retired at the age of 60. The cost of his goals was going up considering an inflation rate of 8% per annum, whereas his portfolio, in its current shape, having grown at 4% per annum for the last 27 years, was only likely to grow at 6 to 8% per annum. Therefore, to meet the goals shown in the preceding table, Mr. Tulwer would need to dig deep into his meager retirement corpus, which in turn would severely compromise the quality of life he and his wife would be able to lead after retirement. On the first iteration, the software showed that his portfolio had to return 21% per annum on a post-tax basis from now if he had to meet all his financial goals. This sort of return was absolutely out of reach for Mr. Tulwer. Nikhil then went over the exercise again after bringing down the frequency of vacations, changing cars and excluding the goal of buying a holiday home. The required return came down to 16% per annum. Given that there was only so much he could expect from his salary and bonuses over the years, his future depended on how well he invested his savings hereon. He had seen a time when he had earned returns as high as 80% on his investments, but in the end those returns had averaged out to a disappointing 4%. He was at his wits' end. He didn't believe there was anything that could deliver a post-tax return of 16% per annum over the next 10 years. The solution for Mr. Tulwer: use the power of equity. Nikhil told Mr. Tulwer that it was a mistake to not invest in equity. Mr. Tulwer had burnt his fingers with stocks and now considered it as risky as betting. After all, he had never made money in equity investing. Nikhil told him that this was because he was making the classic mistakes. 1. He was trading heavily. They calculated that, over the years, Mr. Tulwer's average holding period was 4 months and up to 80% of his stock investments had never lasted more than a year. Mr. Tulwer's high turnover was a broker's delight. In fact, he was paying up to 7% of his portfolio value each year as brokerage. There was no way, Nikhil told him, that he could have generated any returns with such investment practices. The other mistake, Nikhil told him, was that he was an irregular investor who was always trying to time the market. Instead of being invested, he came in and went out as he saw opportunities. This meant that he effectively ended up entering the stock market when the market was peaking and exiting when the market was bottoming out. Nikhil told Mr. Tulwer that equity markets had high volatility and the only way to consistently make returns was to stay invested. For the uninitiated, volatility refers to the amount of risk and uncertainty with regard to the size of changes in the value of a share. This broadly means that the price of the share could change dramatically over a short period of time in either direction. Point 1. Nikhil's message to Mr. Tulwer was clear. More often than not, stocks appreciate when one least expects them to. And they do not appreciate evenly. Thankfully, Nikhil told Mr. Tulwer that he still had time to correct his course. He had 10 years to go before retirement and hence there was enough time for equity to work its magic. Since its inception in 1979, the BSE Sensex has delivered a compounded annual return of 15.8%. Judicious stock pickers had delivered far more in this time period. This 15% return, net of tax since stocks have zero long-term capital gains tax, compared favorably with the pre-tax return of 4% that Mr. Tulwer had historically earned on his portfolio. To highlight the difference and show the power of compounding, Nikhil showed him the final value from each asset class had Mr. Tulwer invested Rs1 Lakh in 1990, the year he started his career. See the exhibit below. At the end of the meeting, Mr. Tulwer was a convert. He realized the mistakes he had made and understood the long-term benefits of equity investment. He swore to become a patient and disciplined equity investor, which Nikhil assured, gave him the best chance of undoing the damage that he had done to his net worth over the years. Mr. Tulwer agreed to invest 80% of his overall corpus, up from almost nil, into a long-term equity portfolio. In the final chapter of the book, we will examine in detail Nikhil's plan to help Mr. Tulwer meet his goals and have a reasonably comfortable retirement corpus. Nikhil meets Mr. Sanghvi. Nikhil ran the same financial planning exercise for Mr. Sanghvi. Due to his aggressive style of investing, Mr. Sanghvi had not only been taken to the cleaners in the stock market, he had also amassed a clutch of commercial properties that were largely vacant now. The promised rents never came, and it was now difficult to exit these properties. His loans in the Hundi circuit were stuck because of the recent slowdown in the economy that impacted small and medium enterprises across varied industries, including his own textile business. The slowdown in real estate after 2013 had jammed the flow of most financiers in the city, which meant that these loans were not getting refinanced and there was no exit. In fact, Mr. Sanghvi rarely made money on his investments and hence needed a big course correction. Nikhil painstakingly explained to him the benefits of patient long-term investing. More specifically, Nikhil highlighted that investing in equity markets for the long term could create significant wealth for Mr. Sanghvi and help him and his family sustain their lifestyle post-retirement. The conversation was surprisingly similar to the one Nikhil had had with Mr. Talwar, even though Mr. Talwar and Mr. Sanghvi were like chalk and cheese as far as their financial status was concerned. In the final chapter, we will examine Nikhil's plan to help Mr. Sanghvi meet his goals. We all make mistakes. Common to Mr. Talwar and Mr. Sanghvi are some very basic investment mistakes that have led to either wealth erosion or suboptimal returns. Listed below are the 7 basic investment mistakes most of us make. No clear investment objective/plan. If you don't know where you are going, you will probably end up in the wrong place. This is one of the biggest mistakes that most investors tend to make while starting investments. They do not have their life objective/goals in mind when they invest. Most of their investing is usually random and based on market rumors/tips. It is extremely important to list one's life goals and make a financial plan to meet those objectives. The longer you postpone getting your objectives baked into a financial plan, the harder it will become for you to meet these. For Mr. Sanghvi, his portfolio had, for most of his life, been just a pot of money to be used for making aggressive gambles. It was only after he sold his company that he realized that his portfolio needed a purpose and objective, namely, to sustain him and his family through his retirement. Trading too much, too often. Too many people trade too much, too often, and do not reap the benefits of long-term investing and sensible asset allocation. Repeated trading and modification in investments usually lead to lower returns and higher transaction costs, which are a source of income for brokers and most financial advisors. Buying and selling investments may be fun, but if you want to benefit from long-term wealth creation, patience is the key. Mr. Talwar realized that he was losing a large part of the return due to the high churn that enriched his broker. Lack of diversification. Different assets carry different kinds of risk and return potential. Hence, diversifying your portfolio is very important to insulate yourself from shocks in a particular asset class. More specifically, adequate diversification across different asset classes can help in sustained long-term wealth creation. Mr. Talwar's concentrated investments in property, both buying property and lending to developers, meant that when the tide turned against real estate, he was left high and dry. That being said, excessive diversification and exposure to too many stocks/funds can also negatively impact the returns of the portfolio. High commissions and fees. Paying a higher fee on your investments over the long term can have a significant impact on the performance of your portfolio. The money you pay as fees and brokerage every year compounds along with your investment returns over time. Many advisors will often recommend high-cost funds or high-cost advisory services to you. Don't let these high costs eat away your returns. It is extremely important to choose funds that have reasonable expense ratios. Mr. Talwar ended up with a much lower corpus from his insurance schemes because most of them had extremely high expenses. Chasing short-term returns. Most investors chase higher returns or yields on their investments without really knowing the risk attached to them. A high-yielding asset is a very tempting proposition, but past returns and/or current high yields are no assurance of higher returns in the future. It is important to focus on the whole picture and not disregard the risk you carry on your investments. Both Mr. Talwar and Mr. Sanghvi got greedy and chased short-term returns through developer and Hundi lending respectively. When the music stopped, they suffered massive erosion in their investments. Timing the market. Markets do not move linearly and are inherently volatile. Whilst there are indicators of various kinds that reflect the market trend at any given point of time, this does not mean that one can accurately determine when to enter or exit the markets. The belief that one can catch the top and bottom is a myth. Mr. Sanghvi ended up losing crores in trying to time the market. The market taught him, as it teaches all of us, that you only end up losing money in this game. Ignoring inflation and taxes, most investors focus on absolute returns instead of looking at real returns. To arrive at actual returns from your investments, you need to adjust for, or subtract, the impact of inflation and taxes. Mr. Tulwer was losing most of his equity returns because his holding period was less than a year, and that meant that even if he made money on stocks, the tax man took away 15% of his gains. Also, both these gentlemen held gold, believing it to be a great asset. But on an inflation-adjusted basis, gold did not deliver much for them in the 27 years since he started working in 1990. Gold delivered an inflation-adjusted return of just 2% per annum for Mr. Tulwer. The Coffee Can Manifesto. Most Indians do not invest in equity at all. Those who do so in a very haphazard manner. The result is that the long-term gains from what is a very powerful asset class have eluded the majority of affluent Indians. Granted, equity carries more volatility, but the rewards more than compensate for this. Also, volatility is sometimes overrated. For a saver looking to build up a corpus for the next 20 to 30 years, 2 to 3 year spurts in volatility do not matter. The longer the time horizon for your investments, the higher should be your investment portfolio's equity exposure. It, thus, sounds counterintuitive for investors when they are told, for example, that they should increase their equity exposure from 5% to 75%. Yet, over a span of 20 years, while the volatility seems like an afterthought, the difference in returns becomes staggering. An investor holding Rs 5,000 in equity and Rs 95,000 in debt, assuming 15% and 7.5% compounded annualized returns respectively, will end up with a corpus of Rs 4.85 lakh in 20 years. If, on the other hand, the equity component was 75%, i.e. Rs 75,000 in equity and Rs 25,000 in debt, the same investor would have a corpus of Rs 13.3 lakh in 20 years. In the course of the next few chapters, we will lay out a very different way to make money and generate serious wealth in India without taking untoward risks and making your broker or financial intermediary rich. Most of these practices are quite intuitive and yet are followed by only a few. In Chapter 2, we will demonstrate how to build a Coffee Can portfolio using consistency of historical revenue growth and return on capital employed. Such a portfolio beats benchmarks across all time periods and also performs admirably well during stressful periods, like the Lehman crisis in 2008, when the overall stock market nosedived. If invested for over a decade with no churn, this portfolio generates returns that are substantially higher than the benchmark stock market index in India, the Sensex. In Chapter 3, we study the impact of expenses on the value of the portfolio. We also witness the evolution of mutual funds globally and in India. Along with this, we also learn the difference between active and passive funds. Globally, we are seeing a massive shift in investment flows from active funds to passive funds because active funds are no longer giving the outperformance they used to and passive funds are far cheaper. In India, we see that large cap mutual funds outperformance vis-a-vis the Sensex has more or less vanished. However, they still continue to charge high fees compared to their global counterparts. In this chapter, we also learn about the introduction of direct mutual funds and the concept of advisory vs distribution. In Chapter 4, we take a look at real estate, the asset class which accounts for the lion's share of most Indian investors' portfolios. We study, in contrast to popular perception, how residential real estate has given very poor returns to investors over long periods of time. We also show the other disadvantages of this asset class: high transaction costs, illiquidity, and suboptimal taxation. Along with that, the bubble-like valuations in the residential real estate in India forebodes sustained underperformance in this asset class in the foreseeable future. Commercial real estate, on the other hand, appears to be a far more promising asset class in India. In Chapter 5, we analyze the potential of smaller companies to outperform large caps in India. The NDA-led government's multi-pronged attack on black money is resulting in the active diversion of savings away from physical assets to financial assets, which in turn benefits smaller businesses disproportionately, relative to the large household names that dominate the stock market. Against this backdrop, we analyze two key drivers of outperformance of smaller companies. They have the potential to grow their profits much faster than large companies and, secondly, as small companies grow in size they are discovered by the stock market. In Chapter 6 we demonstrate how patient investing, i.e. holding stocks for longer than a year, in high-quality stocks helps an investor generate outstanding returns with low levels of volatility. While intuition suggests that shorter investment horizons are akin to speculative investing, where investors do not need to focus too much on the quality of the company, our analysis shows that even for short time horizons, high-quality stock picking is central to generating healthy returns. In Chapter 7, we put our learnings to work to build good quality investment portfolios for Mr. Talwar and Mr. Sanghvi. We study the importance of financial planning as an exercise to match investments with life goals. By combining Coffee Can portfolios, exchange-traded funds, small-cap funds, and liquid funds, we help Mr. Talwar and Mr. Sanghvi look forward to a financially secure future. Finally, in Chapter 8, we put our takeaways from the preceding chapters to work to create a financial plan for you using the Ambit financial planning tool. 3 takeaways from this chapter. 1. It is critical for an investor to nail down objectives and bake them into a financial plan. The exercise helps match the investor's financial goals with the kind of risk that needs to be taken in the portfolio. 2. It is important to not adhere to the age-old wisdom of investing heavily in fixed deposits, real estate and gold. These assets have underperformed equity by significant margins over long periods of time. In fact, these assets have often given returns lower than inflation over long periods of time and thus damaged investors' wealth. 3. Equity remains the most powerful driver of long-term sustainable returns. However, investors need to be patient and systematic with equity investments. They also need to keep their brokerage and financial intermediation fees low.